Hello and welcome. I'm Kelly O'Byrne. I work on the dealing desk here at LCG. Now it's time to take a look ahead at what could drive the markets this week. So we're heading into a busy week for the euro, the pound and the yen. Here in the UK, June inflation data is due on Tuesday and will be followed by the Bank of England inflation hearings on Wednesday. The UK's rising inflation has been a serious headache for the Bank of England over the last couple of months, as the depreciation in the pound following the Brexit referendum has translated into higher consumer prices. The headline inflation in May advanced to 2.9% year on year, but if it rises above 3%, the Bank of England Governor Mark Carney will need to write an open letter to the Chancellor explaining the deviation from the 2% mandate target, as well as why the bank hasn't taken necessary measures, such as raising the interest rates. The latest data suggested that the UK's wages growth slowed to a 1.8% year-on-year in May from 2.1% a month earlier. Governor Carney is hoping the decline in real wages should ease inflationary pressures. But he doesn't have too much time left before the inflation surpasses the 3% level. In contrary, a solid read will mean the lower purchasing power is not translating into slower inflation fast enough. Under these circumstances, if inflation climbs over 3%, Mark Carney and his team will have a hard task during the inflation hearings, where they will need to testify on inflation and the economic outlook before Parliament's Treasury Committee. Now, of course, Carney explains his flexibility regarding the inflation by the extraordinary Brexit reality. As support, Deputy Governor Ben Broadbent said he is not ready to support a rate hike just yet. However, the other MPC members have already started to voice their concerns regarding the rising inflation. And as a reminder, in the last MPC meeting, in a surprise action, 3 members out of 8 voted to raise the interest rates. In his latest speech, Carney introduced macro-prudential measures, such as increasing the capital requirement for UK lenders to bring the credit expansion under control. There's a good probability that Carney defends his position here by stating that the new measures need time to translate into inflation numbers. But the risks are clearly on the upside for pound traders. Cable has been facing solid support at 1.3045, which stands for the 38.2% retracement on the post-Brexit sell-off. The key support to the March to May positive trend stands at 1.2687, the major 38.2% retracement on the short-term chart. Below this level, Cable will step into the mid-term bearish consolidation zone and could extend losses to the 1.258575 area, which includes the 50% level on the March to May uptrend and the 200-day moving average. Now, also on Tuesday, inflation in Europe is expected to trigger less market reaction. The European Central Bank President Draghi has been clear about the reasons for low inflation in Europe. Unless we have a decent surprise, inflation data will certainly not influence the ECB expectations for next week's meeting. The ECB will meet on Thursday, and interest rates are expected to stay at current levels. The main highlight will be the future of quantitative easing programme. The ECB currently purchases €60 billion worth of sovereign bonds per month to sustain the liquidity in the Eurozone and to boost growth. Yet the QE programme will come to an end in September, and investors are craving for a clear hint on what's next. The latest ECB minutes show that the European policymakers discussed the possibility of an unwinding of quantitative easing. Therefore, there is a good chance the ECB reveals at least some insightful details regarding the future of its policy. Now, in the absence of clear guidance so far, we could conclude that a reasonable expectation would be a readjustment in the size of the QE programme, without specifying its duration. We highlight the Eurozone yields rallied over the past 2 weeks on speculation that the ECB would announce a QE tapering. Depending on how the market perceives the ECB decision, the sovereign yield rally could extend or fade. We're ready for two-sided volatility in euro markets. Now, unfortunately for the Bank of Japan, the heavy sell-off in global bonds also hit Japanese papers. To fight back, the Bank of Japan increased its 3 to 5 year maturity bonds purchases. The idea is to take some pressure off Japanese yields, keeping the yields and the yen at low levels. The Bank of Japan meets on the 20th of July and is expected to reiterate its dovish stance and keep the bias negative in the yen. Although the yen is subject to temporary purchases during times of a rush to safe haven currencies, traders tend to perceive these rallies as selling opportunities. Any price pullbacks in dollar-yen are expected to find buyers at 112.32, that's the 38.2 retracement on the June-July rise, 112.80, the 200-day moving average, and 111.65, the 50% retracement. And that's your week ahead update. Please don't forget to follow LCG on our YouTube channel, as well as social media, to get the latest videos as they're released. Thank you for watching and the very best of luck trading.